Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So it led to this massive holding of U.S. Treasuries as they tried to suppress their own currencies and just recycle money back into the U.S. economy. So the reality is we've created and they've created a massive problem for the global economy. But in this scenario, the reality is that the U.S. could pay the price if people start to panic out of this. And what would be part of that process? And what would be some of the major fallouts from this? Well, if the global reserve currency status is in jeopardy, and we're watching this very, very closely, the first thing we think you're going to see is this idea of being floated, and we're already seeing it being floated in different ways, whether it's SDRs through the IMF. SDRs are a kind of a proxy money that the International Monetary Fund uses, and China and Russia have already called for some type of monetary system set up on an SDR. But I think what you'll start to see is this idea of a currency basket approach to global commodities. And as I said before, one of the reasons the U.S. dollar and the U.S. government is able to maintain its financial power and political power is the currency reserve status. And if we start to see a currency basket approach by other countries that are afraid of all this debt and all this risk rising, systematic risk rising, as Taylor said, I think the first thing you'll see is go to a basket because there's really no currency that can take over the role.
But hey, Jack, I think I just downloaded your the other slides. See if you can click on this. Just drive them forward. Oops. No. Okay, sorry about that.
I think I made a beautiful chart there. I hope everybody can see that.
Yeah, it does look great.
I'm sorry, I was very late with that, so it sure wasn't
ISE's
fault, so no, it's purely mine. So anyway, we had to move to this currency basket, and we're guessing, if you go to a currency basket, who knows, maybe the dollar's 70% down to 50% of the basket, maybe the euro represents 30, yen 10, the pound 10%. If OPEC is concerned about this, and OPEC is a major player, and oil is a major driver of all global wealth and growth, needless to say, we're already seeing countries calling for oil priced in other currencies. We're already seeing countries like Iran take euros for their oil. If we see OPEC get very, very nervous about this systematic risk flowing from the U.S. because of their massive debt that they're pumping into the system and the monetization of this debt, treasury debt, by the Fed, the dollar then goes from 100% trade in oil down to 50% or 70%, whatever that is. That's a massive hit in terms of pressure or demand for dollars coming off in a very, very big way. Remember, all of a sudden those countries that need to hold only dollars to buy their oil, all of a sudden only need to hold about half as many dollars to buy their oil. They need to hold more euro and maybe more yen and more pound. So on a relative basis, just this idea of shifting a major global commodity like oil to a currency basket would have a massively negative effect to the U.S. dollar.
There you go, Jack.
Okay.
Sorry. Just, if you need those charts again. Oh, I guess I can drive them. Sorry,
okay.
It's me driving. If I click on it, it just drives it. If you want to make another point, otherwise I don't think you can use the pointer, but I think these are the beautiful art that you just created. I think it's right here. Can you see it?
Is it the other, is it the other? There it is. Yeah, let me get to that.
Jack's chart, yeah. It should be Jack's, yep.
There we go. Thanks, Steve. Everybody see that okay? See how beautiful my chart was? It was looked just like this. So
replica.
This is 1970, holding of U.S. Treasury debt going along just fine. All of a sudden we had a recession. We had this concern about global deflation. So the Fed pushed interest rates down to 1% to try and stave off global deflation. And that 1% basically meant free capital to the investment banks in New York, which are no longer with us. And they created this massive pool of money in the world, which led to a massive accumulation of U.S. Treasury debt around the world because of recycling back into treasuries because of that huge boom in global asset markets, the very consistent boom of many asset classes going up together. So this was a very pivotal period, this 2001 timeframe, when Mr. Greenspan came in and saved us. I think we're all learning historically that maybe some of the things Mr. Greenspan did, a lot of people wanted to anoint him king back then, in retrospect aren't looking so good. But again, it's easy for me to make that call, again, with hindsight. Greenspan's a very smart guy, and he wasn't the only one making these same calls. It wasn't all him. A lot of people were doing the same thing. And here's that number right there, 3.265 trillion of just Treasury. So if you layer on here the agency, layer on the corporates, this number gets much, much bigger. And you can bet if the U.S. bond market starts to break and the U.S. dollar gets in trouble, they won't be just selling U.S. Treasuries. And again, this is the disaster scenario. Then we still don't put a very high probability on it yet, but we have to be open to it. They're not only going to dump the treasuries, you're going to see agency debt be dumped and corporate debt dumped too. So the weight of a negative move here on systematic risk is the scary scenario. So another chart that I had in here, and I think this is a very important chart for us to look at. Back in the end of 2007, this is the U.S. debt to GDP was around 40%. It represented $32,000 in debt. Federal debt for every person in the U.S. It's just hard to fathom when you think about it. And again, you saw this will start to stabilize and then a hike up from 2001, flat in here, and just starts to rocket. And part of this rocket too is from right in here is when the Asian surplus countries started recycling their debt into the U.S. economy right after the Asian financial crisis hit. So 1998, 1999, if you put a chart of U.S. housing prices on here, you'd see them take off right at the same time because of that extra credit coming into the system, making it easier to finance houses. So it's all this stuff tends to be tied together. So at $32,000 per person of federal debt, what happens at 80% of GDP? Well, then federal debt goes to $64,000 per person. That's a heck of a lot of debt, needless to say. And if you're a hard money person deep down inside, and I am, and we are here, and you're not a Keynesian, you're not necessarily a monetary policy guy, we're hard money guys. We look at the Austrian School of Economics. Real wealth in the country is built by capital investment per person into the country. Savings, those type of things, pools of real savings. Debt levels are just the opposite of that, and they drain wealth, and they ultimately come back to bite in a very, very big way. And that's, we may be paying the piper soon, and I guess that's what this section of the presentation is about. But you'll start to see that. You'll see a call for these currency baskets, as I said, so keep an eye out for that. And needless to say, if this starts to play in, the dollar will already start to fall off the table in a big way.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.